Robschild, nothing I say is investment advice. Welcome to the show where we view financial markets through crystal ball gazing. JP Morgan once said, millionaires don't need astrologers, but billionaires do, and so we begin. Today is actually Saturday, June 29th, but the show's for Friday, June 28th, 2024. Today we're going to talk about the PCE numbers first, the personal consumption expenditures. I've been talking about this for 2 weeks now, this data coming out, and it actually came out, some people are saying it came out cooler than expected, and it didn't really. It came out pretty much as expected, but interestingly, specifically for the regular PCE number, we went from a last reading month over month from 0.3% to an expectation of no increase over that month, and that's what it was. We had no increase, so completely flat. If this were to continue long enough, it would indicate that the cooling is here and here to stay. According to Ira Epstein, guy that's been studying markets for like 60 years that I watch frequently, his take on it is that you need 3 months in a row of like obviously cooling data in order for the Fed to finally say, yes, we're cutting now. That's his idea on it, and based on his experience, I wouldn't doubt that that's really what's going on here. But anyway, to go through the rest of this, year over year, still at 2.6% over the Fed's target of 2%, but this is not a scary number. This is certainly not going back upwards. And then for the core, as expected at 0.1%, last was 0.3%. And core PCE year over year, as expected, lower than the last reading of this, down to 2.6%. So a lot of this was already priced in. This is what the market was expecting, and we got it. Oddly enough, we had a little bit of a interesting divergence here between personal income and personal spending of May, mainly being that the last of the income was 0.3%. We expected it to go up only 1/10. It went up 2/10 to 0.5. So personal income rose more than expected, and that can give consumers more weight as to, that can make inflation a little stickier for sure. And then, but personal spending, people are actually spending less than expected. We expected to jump from 0.1% to 0.3, and instead we got 0.2. When I first saw this data coming out, I was excited. I thought, like, okay, yeah, this is cool. I mean, if there's no inflation overall for PCE from 1 month to the next, shouldn't that be seen as cool? Shouldn't that mean that rates should be expected to be going down? Shouldn't that mean that people want to lock in a higher yield of return and therefore, make TLT go up and yields go down? The opposite happened, so let's jump right into that. This is a chart of TLT on a daily time frame, each candle representing 1 day. As you can see, on Friday was a very large red candle. Normally I would say that this is pretty bearish looking, except for the fact that the day's over. I don't think this is a reversal in trend. In fact, if you take some lines here, you can see we're not even, if you consider this to be a parallel line to this bottom here, we didn't even hit it. So, the bears were in control for the day for the most part, but it's over. I think the selling's over here for a number of reasons. So, what happened? So the PCE data came in cool, as you may have heard other people talking about. A lot of it had to do with the presidential debate between Biden and Trump, and my understanding is that, so, a lot of people, I don't want to get into politics at all, but a lot of people were thinking, a lot of conservatives, the typical, left-right thing, just in general terms, the left wants to spend more money, the right wants to cut taxes and maybe not spend so much money. But the problem is that both of them are big spenders. Neither of them have anything in their head about cutting fiscal spending, and that's very stimulatory. And what that can do is it can force yields to be higher. If people are going to be investing in dollars, but the value of dollars over time is seen to be shrinking going into the future, then people are going to be dumping treasuries. And so I think a large amount of the dump of treasuries was probably international sellers, for the most part. This is a complex thing here. So, as rates go higher, it's more expensive to borrow money. And with the economy cooling, it's like, it's interesting because the lower TLT goes, the more attractive it becomes as an investment, especially at this point in the cycle. But yeah, I mean, if our government continues to spend more and more and more and more, it's a real risk. Again, the dollar is largely seen as the sort of cleanest shirt in the dirty laundry, so to speak. And so, you can see that in the dollar. So let's go over to that. So you would think that, maybe, there'd be a run away from the dollar, and it was a little bit bearish, but overall the dollar is really holding up here. So again, this move on TLT, even though it looks like a scary big red candle, I don't expect it to roll over down here. I see this as a buyable break. But again, this is, never any investment advice. Better off putting it in a wheelbarrow, lighting on fire, dumping it off a bridge. But I still think right now where we are, it's the safest and best place to be, and it's where I am with 50% of my own portfolio. So, but we'll see how that works out. Taking a look at TYX, this is the 30-year Treasury yield. Yeah, it had a jump today, but this is nothing all that scary to my eye. In fact, I might even be able to call this the typical head and shoulders pattern. Again, you have to actually see the shoulder roll over for it to go that way, but I don't see that as out of the realm of possibilities. Of course, if this goes that way, then that TLT will go up in value. A few other charts I just want to go through. We'll just go through, this is the S&P 500. This is a daily chart. Notably, it doesn't look like it, but this is an engulfing candle here. We had the open on the 27th at 54.73 and the close at on Friday at 54.60. So that is lower than the open, right? Open 460.71 and then close 460.49. It counts as an engulfing candle of these 3 days. Maybe you can see it better. No, you can't really. And it has a large topping tail. So in other words, people got excited, they got beaten down by the sellers. And then we closed below these past 3 trading days. This is a bearish candle. This looks like the S&P 500 wants to go into a little bit of a correction here. Moving on to a weekly chart, we see a similar kind of thing, these topping tails with sort of a doji pattern. Again, this week is closed now, and so this can lead to, for sure, a reversal. As you can see, for example, here you had 2 dojis in a row, and we went up and then went down afterwards. But it's just, I wouldn't be personally buying the S&P 500 considering these patterns and everything going on. I wanted to bring up IWM. This is the Russell 2000. Oddly enough, you'd think that the cost of borrowing money is going up when TLT is going down. That's not very good for small caps. The S&P 500 is not looking strong, as an index, and yet for the day you have IWM, the Russell 2000, actually closing up 0.4%. And so it's like people want more risk. They want higher return. I mean, it sort of makes sense, right? So if the expectation is, I think really what's controlling here was the debate, and I think that's correct, is that the worry now is that we don't have a candidate now that is, saying, hey, maybe we shouldn't spend as much money. And as long as the government is spending a lot of money, it is stimulatory, and it can heat business up, and it sort of can make sense for the Russell 2000, not very intelligently, but it gives it some of a reason to increase in value off of that news. And then the last chart that I want to bring up is HYT, high yield corporate. Some people call this smart money. I call it the dumbest of the smartest money. Interesting day. We had, again, this is an engulfing candle of 3 trading days. To the penny, it did engulf all 3, actually. So this is bearish officially. So, while stock buyers, dumber money, is getting excited here, HYT is saying, hold your horses, friends. It ain't over till the skinny man cuts rates. And that's all for today's show. Again, overall, I see the S&P 500 rolling over here. I think that the TLT sell-off will be seen next week as short-lived. I still expect it to increase in value, especially as the expectation of rate cuts are coming, and there's a little bit of a run to safety. It's all in the crystal ball. That's all for today. I hope you enjoyed. Thank you for watching. Robschild.